Okay. Good morning, good afternoon, good evening, everyone, and welcome back to the third workshop of the beginners. My name is Vito Hinjaro, and welcome back to OctaFX webinars for beginners. This is the third, and I believe this is the last part. So there's a lot to cover on tonight's session. Pay close attention. There's going to be a lot of stuff that we're going to go through. Number of slides I can tell you right now is about 75 slides. All right. So this is part 3, risk management, and then the tools to help you predict the market. There are a couple of questions that was asked, asking me who am I. My name is Vito Hinjoro, and I'll cover in a bit on what my experience is. So I'm not some just random Joe that you picked up from the street and pretending to know what to do with Forex. I've been in the industry for close to 20 years right now. How to get this platform working? We discussed the platform, how to use the platform yesterday. So if you can review the video from last night, that'll be great. That's going to be part 2 of the webinar. So we are just going to get started. By the way, just to ask you where you're from and what is your experience in trading. If you can let us know in the chat, that'll be great. And that way we can help out in which part of the journey that we need to help you with. Okay. So my name is Vito Hinjaro, and I've been a full-time trader since 2004. Obviously, start trading in 2004, dabble in it before that. I've been a trader mentor since 2007, meaning I'm actually engaged to teach traders how to trade from some funds industries. And I've been a chief technical strategist for Forex CT, technical analyst for Asia Pacific Global Forex Trading or Gain Capital, chief technical strategist for Invest Financial Services, which is listed in Japan, as well as having my own independent research company, which is Zenifix, which is in Australia and Indonesia. Also was a member of the Australian Technical Analysts Association and the Australian Professional Technical Analysts. My expertise is combining Eastern and Western trading methodologies, so that's more on the technical side of things, which is using Ichimoku Kinko Hyo and Fibonacci. Okay, just a little bit of stuff that I've done before. Written articles, obviously, reports, outlooks in English, published in Time, and written for Japanese publication as well. On TV, Channel News Asia. If you guys are in Singapore or Malaysia or Indonesia, probably have heard about them. Speaker for Invest Carnival, Invest Fair in Singapore, BBC UK as a guest, and also host for CNBC, co-host for CNBC as well. Anniversary, silver anniversary, which is 25 years anniversary for the ATAA. Was one of the speakers there next to Daryl Guppy. If you know the Guppy Multiple Moving Average, that's the guy there next to me in the picture. I've been on the radio, obviously, and I've been doing seminars globally around the world. Dubai, Malaysia, Singapore, Australia, just to name a few. Okay, so here are the agendas for tonight, and I'm gonna hide my camera for a little bit so you can see what's going on the screen instead of focusing on my bald head over there. So I want to talk first about the importance of a trading plan, and then we're going to take a look into what the risk factors are in trading, which is your trade risk, your capital risk, your market risk, and we're going to go into position sizing. There were a lot of questions yesterday asking about how big of a position I should open with this kind of equity and whatnot. So I'm going to give 2 examples later on, and we're going to take a look at how important position sizing is, and then correctly understanding the leverage and how to use it in your risk management. So we're going to calculate position size with leverage, capital risk, and trade risk included. This is going to be a brief rundown. I'm not going to go into too much details into it because otherwise we're not going to cover it. We could be sitting here for about 4 hours to run through the webinar. We only have 1.5 hours to go. All right. I want you to understand what the risk to reward ratio is and how is it important for us as traders. And then we're going to take a look at fundamental analysis. What are the key data for Forex, which is quite a bit, which is GDP, CPI, and whatnot. We're going to cover that tonight. And then we're going to show you how to utilize the economic calendar that's actually on OctaFX website. And then we're going to wrap things up a little bit with technical analysis, identifying key levels in the market. We're going to talk about trend lines and then triangles. Okay, so this is a promo code for the account opening. The bonus is 100% deposit bonus. So if you deposit 100, then there's going to be a bonus of 100. That's going to be added into your trading balance, and this is the code. To get this working, I believe you need to have registered for the webinar on the website, and then use this code to open an account. That's beginner INT1. Okay, this code is going to appear again at the last slide when we are going to be doing our Q&A. Okay, but I'm not sure if we have time for Q&A because we're gonna really cram a lot of the stuff here tonight. All right, so let's begin. And if there's any issues with audio or video, do let me know so I know what's going on, because I'm gonna be so focused on the slides, presenting this to you. So I'll check the chat once in a bit. Okay. I am very well, and how are you guys, by the way? Staying safe, I guess. All right, let's start. Importance of a trading plan. Number one rule in trading is never trade without a plan. Okay, that means not knowing what to do, not having a strategy to tackle a trade. There are several strategies out there for you to start with, to begin with. There are some that we cover in the OctaFX channel in terms of the education webinars. There are multiple trading plans out there that you can use. Ideally, you are going to be using your own trading plan in the future once you kind of understand what's going on in the market. Okay, but basically your trade management must comply with the rules set out in our trading plan. Okay, so if I say get in now, that means I have to get in. I have to follow whatever rules I created. And you got to remember that trading relies on probability. So how to actually be successful is not how clever you are in looking at the market or how clever you are on predicting where the market's going to go. It's actually more about consistency and your discipline in managing your risk and adhering to your trading strategies that can make you successful. Okay, it's not being about understanding or knowing a lot of the technical tools that's available. It's knowing how to use it and how to plan on using it well. Okay, that's more on the risk management. That's why we want to cover risk management today. So this is going to be a very important webinar where we talk about risk management. So you definitely need to have a plan to enter a trade, and we're going to walk through that on how to actually start creating this, which is basically your position size, your risk to reward ratio and whatnot. When you create a trading plan, a lot of people tend to just aim for the profits. It's not going to do that. Okay, like me, for example, I don't actually calculate the profit first. I'll calculate how much I can lose, and then I'll calculate how much of a profit it is before I actually get into a trade. That way I know whether a trade is worth taking or just leave it alone. All right, so we gotta know about your risk limits as well. What is your risk tolerance? That's something that we're gonna talk about as well, and figuring out when to exit your position. There was a question yesterday in terms of overstaying in a position. We are going to talk about that on how you shouldn't be overstaying in a position. Okay, so in a nutshell, successful traders are those who are actually well prepared for all the possibilities before opening a position. Successful traders are those that know that they could be losing a certain amount of money. They could be earning a certain amount of money before they even open a position. So all is already part of the plan before they even start. All right, here's what happened without a trading plan. You don't know what to do if you're wrong or right. In fact, you don't even know whether you're right or wrong because you don't have a trading plan to begin with. If you're profitable without a trading plan, that's good job. But those profits can turn into losses because you don't know when to exit, and this is overstaying a position. Okay, changing your trades or analysis halfway through, even though you have a plan, I would just say that means you don't have a trading plan at all. So this is the way it goes. After your trade is executed, your control of a trade is not in your hands anymore. It's other than adjusting your stop losses according to your trading plan. Okay, once you execute a trade, that goes into the market. That's in the market's hand. All right. And here's the problem without a trading plan, because then you're gonna start hoping. Some of the people here that might have traded before probably had this feeling. They started hoping that the market's going to turn around. When you start doing that, that is the worst emotions in trading. when you start hoping, you can very well know that you are actually wrong most of the time. Okay. um, Hoping is just a false sense of security. It'll kind of give you that sense of security that you think you're right, but if you start hoping, that means something has really gone really bad in your trade, and that will cause you trading bias, because you are going to insist on staying in the wrong position. So the solution is here. When you have your hope, or you start doubting your positions, then most of the time, 80% of the time, you may have been wrong. Okay, what you need to do is you need to review the situation. You need to look at the market conditions. We talk about trends and stuff. um, and if it's necessary, you need to immediately cut out of that positions. You need to get out before things get worse. Okay, I know for sure that I've been mentoring traders for 14-15 years now, and I know that the biggest problem that a lot of people have is they are gonna let losses run. And this comes to the next problem here, which is taking small and quick profits, but then you let the losses run into big losses. So this will definitely occur when there is no trading plan, number one. Okay. 2 consecutive losses will cause you fear, doubt, and will definitely have a psychological or mental impact on the trader in the long term. So 2 trades is all it takes. That's from my experience, that's from my research. 2 trades, 2 consecutive losses, that's going to cause you to be afraid to actually get into a trade. You're going to start blaming the brokers, you're going to start blaming people that give you that trade ideas, you're going to start blaming everyone. But at the end of the day, the one that pulled the trigger is you yourself. No one's forcing a gun to your head and say, okay, you have to trade. Okay, but that's that. So to me, trading is simply systematic. Okay, it means that I need a blueprint, or basically planning of a trade is definitely necessary. Now, understand the trading plan. All right, let's move on to the risk factors in trading. We actually have 3 risk factors in trading. Number 1 is capital risk. Okay, that is risk that have an impact on your capital or account equity, which is what we discussed yesterday as well. What is your account capital? What's your account equity? This is part of the money management risk, and the calculation of the maximum lot size to maintain your equity and margin level is considered to be part of the capital risk. Then we have the trade risk. The trade risk, as the name says, is basically the risk that is directly associated to your trade, to a particular trade. And this includes the risk management of that particular trade, which is figuring out your entry, figuring out your exits. Your exits means your stop losses, where should you cut your loss, or where you should be taking your profit. So when I say exit, it's two things there: your stop loss and your take profit level. All right, there's always going to be 2 exit. Either you lose the money or you gain something. So that's your exit. Figure out your exit first, your entry comes second, because once you understand your exit, then as we go along, we're gonna take a look at the comparison between those entries and your stop loss, which is your risk to reward ratio. Okay, stop loss and take profit levels compared to the entry will then become your risk to reward ratio. It's bolded, which means we're going to be touching on that tonight. The other part is market risk, which is we're going to be talking about that during the fundamental side of things tonight. These are risks caused by economic, political, or geopolitical factors. This is not within your control. Your control is your capital risk, your trade risk. Those 2 are in your hands. You are controlling them. Okay. So let's take a look at some risk tolerance and risk to reward ratio, and this is kind of a way to identify what kind of traders you are. Individual risk tolerance per trade and account. When I say you have a low risk tolerance, that means you're risking 0.5 to 2% max. Medium risk tolerance is 2 to 5%. High risk tolerance, that means you're okay with risking a lot for a bigger gain, then it would be more than 5% of your capital. You're willing to risk that, then you're considered to be a high a risk tolerance trader. Now, when we talk about risk to reward ratio, is how much you're willing to lose, how much you're willing to gain. Low risk means you want to have a larger risk to reward ratio. For example, you're risking $1 for $3 gain. That's 1 to 3. This is typically for longer term trader that has the bigger risk to reward ratio. Medium risk to reward ratio falls to 1 to 1.5 or 1 to 2.5. That's swing trading. High risk, basically 1 to 1. I'm okay with that, or even I'm risking more than what I could be gaining. My stop losses is 10. I'm only aiming for 5. That's 1 to half. Those are typical for day traders and scalpers. Okay, so this is gonna help you figure out. You need to ask this to yourself because I cannot answer that for you. This is questions that you need to answer for yourself. How much risk tolerance do you have? And what kind of risk to reward ratio that you want to be able to create your own trading plan. Okay. So, know your potential profit targets first. Estimate your likelihood of right or wrong with fundamental or technical analysis. So I do that in combination of the two. We talked about this yesterday. I say 80% is actually in your head, 10% fundamental, 10% technical analysis. So the most important thing is you know how much you are at risk before making a trade. So that's why we need to calculate your exit level first, which is figuring out your stop loss, which is figuring out your take profit level, which means figuring out what if things go wrong, where do I get out? What if things go right, where should I get out? Okay? So use the stop loss and stick to what was planned in your trading plan. If your trading plan says, okay, the stop loss has to be, a trading stop loss like the one we showed yesterday, then that's going to be part of your plan, right? Every time the market moves up, the stop loss moves up with the market to protect your position. But two things to remember: you would definitely want to cut your losses. If you see losses that you're not comfortable with, cut your position. But if you are profitable, then let that profit run. But don't overstay because you have your exit level. If it hits your exit level, take your take profit level, then get out. Don't overstay. Don't get greedy and say to yourself, all right, maybe it might go higher or maybe it might be more profitable. Don't do that to yourself. Okay, that's gonna ruin you mentally before you even start being experienced in trading. So the quote here is basically manage your losses and the potential profits will manage itself. So you don't actually have to worry about the profit. You need to manage your losses first, and that's the most important key in the fundamental of risk management when it comes to trading. Okay. Now we want to take a look about consecutive losses or drawdown. How do you actually calculate it? All right, so we want to convert the risk percentage into risk costs. For example, I'm risking 3% on a $10,000 account. So I'm talking about capital risk right now, which is something that we're going to go into detail soon. But right now, just for example, you don't think about your anything. You're risking 3% on your 10,000 account. That's basically $300 risk per trade. The percentage will change for every trade because not every trade is going to be $300. It could be a $50 risk. It could be a $200 risk. But I want to convert my percentage of my capital into cost. That way I can actually calculate by using the formula 10,000 divided by 300. And that's going to get you 33.3 trades using this example. That's the amount of trades you can actually lose out, which is what we call a drawdown or consecutive losses. However, this formula doesn't take into account the margin, the leverage, and whatever not. So this is just a simple analogy. We're going to talk deeper in this once we have the risk management session. But this is more of an introduction. So take this as an example, as a rough guideline on how you do it. Okay. So this is the number of drawdowns, which is 33.3 trades or 33 trades based on trade risk only, and trade risk in this example remains constant at 3%. So take that note over there. Don't just blindly take this calculation and make it a formula. It's not. It's just there to illustrate how do you actually calculate your drawdown, because you need to factor in your margin, level, you need to factor in your equity as well. So in advanced risk management, when we do that in the future, then we're going to talk deeper into how to actually do all this. But it is required to factor in your capital risk in combination with your trade risk to achieve a much more realistic drawdown limit. This is not realistic. This is just an example, okay? Right. Leverage, I keep mentioning it. Day 1, I talk about leverage. Day 2, I warn you about leverage. Day 3, I'm going to warn you about over leverage. Remember that, again, leverage is a great tool for trading, but not a tool to get you rich overnight. So please, if you think that you're trading Forex and then you're going to get rich overnight, this is not the way to go, okay? To make you be a successful trader, you need to be able to set aside amount of money that you are actually comfortable losing, and it's not going to affect your lifestyle. If you're putting all your life savings into trading Forex and hoping that you're going to be a millionaire or a billionaire tomorrow, please don't do that out of respect for you. That's just crazy, okay? So this is not a tool to get you rich. Do not overuse your leverage. Do not over leverage. Okay, so you need to manage your position based on capital and leverage. Let's say we have a capital of 5,000. Then we have a leverage of 1 to 200. Aussie 200 trading at 4,000. One lot is equals $1 a point. Margin required for one lot is 4,000 times 0.5, which is gonna tell you that it's $200. Okay. Then your available equity would be 5,000 minus 200, which is your margin required. That would be 4,800. And that would mean sustaining the ability to sustain a 4,800 point in Aussie 200 or the ASX 200, which is technically, it cannot go to zero. Okay, so it's impossible for you to lose all that money that you have if you manage it correctly. Okay. If you take a look at this, if you're willing to risk $100 and only $100, so the risk cost is constant at 100, you have a lot size of 1. That means per market movement limit is at 100 because 1 point is a dollar. You're willing to risk $100. Okay. If you open up 2 lot size, then automatically your market movement limit is going to be at 50 points. If you open 10, then you can only move. The market can only look. The market just needs to go against you for about 10 points, and then you're taken off the market. End of the story. Okay. You need to look at the daily average of the instruments that you're trading. For example, in this example, the Aussie 200, that's about 60 to 80 points in one day. Calculating your maximum risk per trade, 2 to 5% of your capital. 5,000 times 2% is 100. That's why we have that 100 limit over there. Risking $100, allowing you 100 point to move against a position. If the position size is 1 lot, you open 2 lot, it becomes 50 points. You open 10 lots, the market only need to move against you for 10 points, and then you're taken out of the market. Okay, so when I say someone using leverage and they overuse leverage, I call it just a sudden death, because you don't even know what's going on, and all of a sudden you're taken out of the market. So you're not able to control the speed of the market. And when you overuse leverage, it's just crazy, because transaction cost of high leverage as well needs to be considered. Most traders don't see it coming, and when they do, it's already too late. Not only does it amplify your losses, amplify the transaction cost as well as a percentage of your account. Remember, we talked about margin level yesterday. That's basically that. Okay. So you need to remember that leverage used correctly is a great tool. I can tell you it's a super wonderful tool that was, I don't know, it's probably one of the greatest invention that people have created in terms of trading. But used improperly, it'll just empty out your account in a blink of an eye. Okay, so if you're a beginner and you come here thinking that trading Forex is going to make you a millionaire overnight, or you're going to start earning, I don't know, deposit 100, earn 1,000 tomorrow, that's not gonna happen. Okay, because you're gonna be over leveraging. You're just gonna burn out your account. Might as well just take that $100 and throw it into the ocean or whatever. Okay, I'm not here to discourage you. I'm just here to tell you the fact that this is not a get rich scheme. Okay, if anyone is telling you that, then I don't know what you're here for. Okay, you're here to be educated. You're here to know what's the truth behind this and what's the truth behind leverage. All right. So Margin requirement formula divided by trading costs, or trading costs, sorry. Your required margin, we talked about this yesterday. This is basically your trade size divided by your leverage multiplied by your account currency exchange. The system is going to automatically do that for you, so you don't have to worry about this, but the formula is there if you want to. But you can always go to OctaFX website, and under the calculator side, trading tools, I believe there is a leverage calculator or your required margin calculator there. This is an example on the Euro USD on 1 to 200, one lot, one standard lot. Your required margin is 610. So if you want to be trading one lot, then you definitely want to have more than 610 in your account to start with. Okay. If you're trading 0.1 lot, then your required margin is only 61. Okay, this is again using leverage of 1 to 200, just an example. If you trade 0.01, which is a micro lot, then your required margin is only 6.1. So if you're depositing $100, then trade micro lots. Don't trade mini lots, because that's just 61. All right, that's 60% of your account as a required margin. That's ridiculous. Okay, so you want to be safe, then trade your micros. Hope that makes sense. Right. On the Euro USD, take a look at this one here on the micro lot. Remember, we have 6.1 over here as a required margin. This is on a leverage of 1 to 500. Obviously, your required margin is going to get smaller because it's at 2.44 right now. That's one way to have a minimal capital and then be able to trade bigger, but just make sure that the leverage can go against you as well. All right, so let's go into position sizing. The importance of measuring your position, that's basically position sizing, right? Very few traders actually realize the importance of a balanced position size in a portfolio when they create a portfolio, or when we talk about, building a portfolio, means you are having a position in a couple of instruments. That's a portfolio for you. Traders often make the mistake of ignoring the size of their trading account. Okay, when taking a new position, I write trading account twice because I don't want you to ignore how big your capital is to begin with. The safer bet is to have a bigger capital to start with. That way you can actually withstand market movement. If you're going to start small, then trade small. If you deposit small, then you want to trade big, then that's just going to wipe you out instantly. So balance it well. Okay, so you need to know what your risk is, how much you're going to be putting into a position size that we talk about, whether it's a mini lot, a micro lot, or a standard lot. Okay, so if you don't understand this, unwittingly, everyone basically becomes a high risk traders because they don't know what's going on. They are risking 60% of their capital just to open a position, for example, in the calculation just now, and soon find themselves in deep trouble in terms of the side of positions taken and the imbalance with their own capital. So position sizing is there to protect you by limiting your capital losses. We talk about the risk tolerance. How many percent are you willing to risk on your capital per trade? How many percent of your capital that you're willing to risk basically tells you what kind of person you are, what kind of risks you are willing to take. So here's the golden rule of position sizing. Never risk more than 2% of your trading capital in a single trade, or more than 5% of your capital at a time. This is obviously the golden rule. This is a rule that I adhere to. Okay, everyone's going to have their own rule depending on it, but from my research, this is the right balance. 2% of your trading capital in a single trade, never risk more than that. Okay, in total, when you have two positions, that means you can open two trades, risking 2%, doesn't exceed your 5%. Okay, sometimes you can extend it to 10% of your capital if you have a few multiple positions open, but try to limit your risk trade to just 2% of your capital. So here's your position sizing formula. This is your equity minus margin required multiplied by your maximum capital risk, which is risk associated to your account balance. Okay, and then equity minus margin required multiplied by your maximum trade risk, which is risk associated to your trade. So there's going to be changes in your trade risk, but typically there are no changes to your capital risk because you decide how many percent max that you want to do, and then you take a look at the trade risk and make sure that the combination of the trade that you have, the sum of it doesn't exceed the trade risk that you have. Okay. Traders can choose to use all of the maximum capital risk in one trade or split the position using the maximum trade risk and not much more than the maximum capital risk. Again, the word here is not much more than the maximum capital risk. Okay. There's a question there. How much optimum leverage for newbie with 300 USD capital? I would say 1 to 400, 1 to 500. That's fine, but make sure you only trade micro lots. Trying to go into mini lot, that's already risky there. Okay, it might go beyond your maximum capital risk. All right, here's an example just to make things clear to everyone here. Let's say you have an equity of $50. Your leverage is 1 to 200. Your maximum capital risk, your equity minus margin required multiplied by maximum capital risk. We talk about this. And then we have your maximum trade risk. That means 1 pip standard lot is $10. Okay. A standard lot is equals to $10. That would depend on the currency pair, but let's just use $10 for example, because on euro pound it's slightly different. 1 pip mini lot is basically $1. We just say simply standard 10, mini 1, micro 10 cents. Okay, from the example above, mini lots with equity of 50 are not able to trade mini size due to insufficient margin requirement. Micro lot has a capital risk cap at $2.10. Okay, that's $50 minus 6.1 required capital to open multiplied by 5%. Or basically a maximum of 21 pips in total for the market to move against your position before you're taken out. Simple. You want to screenshot this formula, screenshot it, learn it, that's fine. Review the video later on, that's completely fine. But here it is, here's the calculation. This is an example of 50 with a leverage of 1 to 200. This is a deposit of 500 with a leverage of 1 to 200. Obviously, there was a question there asking 300. I would say the leverage would be 1 to 400, 1 to 500. That's still okay to lower your margin requirement. Okay, but 1 pip standard lot, your margin requirement is 610. For a dollar position, your required margin is $61. For a micro lot, again, it's $6.10. Now, standard lot with equity 500 is not able to trade mini size again. It's not able to trade standard size due to insufficient margin because you have 500 and you want to open a position that has a required margin of 610. That's not possible for you. Mini lot, if you trade mini lot, has a capital risk cap of 5% at 21.94, which is 21.9 pips total. However, if you trade on the micro lot, you can withstand a market movement of 246.9 pip in total. That's a lot of pip movement. You are safer that way in terms of your capital. You're protecting your capital. So what's logical here? The logical way, if you have 500, don't even trade mini, because 21 points, which is only 20 pips, is going to take you out of the market. But 246 pip, okay, that's reasonable. That's going to take a bit to basically come back and smack you, right? So I would say if you don't have 1,000 in your capital, don't even attempt to trade a mini lot. Simple as that. Okay. Trade the micro lot. That's completely fine. If you have 10,000, then you can trade the standard lot. That's completely fine. Okay, or a mini lot. Okay. So we're gonna move on to stop loss and profit target planning. Basically what we want to do here is we want to figure out the distance of your stop loss or profit target is. Right now you don't even have the tools to do that because we haven't even gone deep into it. But I'm gonna show you a chart pattern that we can use to kind of understand where the support and resistance is, what happened in the past. That's going to be useful in the future. That's going to help you figure out where your stop losses or your profit target is. Okay. Determine your position size once you know your stop loss and your profit target. Then you decide how much you want to trade. Okay, because if you don't know your stop loss, if you don't know your take profit, you are not able to calculate your risk factor in there. Okay, calculation of how much you made or lost per point or per pip move, the distance between your entry to your stop loss multiplied by the movement of those pip is basically your risk. If your stop loss is 20 pips away, you're trading on a standard lot, multiply that by 10. Obviously 20 by 10 is 100. Okay, but 20 by 10 cents, how much are you losing? $2. Okay, so that's quite a difference there. But you need to calculate how much of a capital risk that you're willing to take on, what you are able to do in terms of your required margin and whatnot. That way you can actually calculate your stop loss and whether or not you want to get into a trade. So too often traders focus on the right entry at the right price at the right time. We'll talk about this just now. It's not important at all. It's actually rubbish. If someone tells you, I am so good at predicting an entry, I'm so good at predicting, when to get in, when to, this is the time market's going to move, or the market's going to turn now, run away. If someone tells you that means they're scammers. Just go away. Okay, it's bullshit. No one's going to be able to do that. Okay, precisely telling you, the market is going to turn now. I can predict, I can give you a probability, 70% of the time, maybe the market is going to turn around right now because the signs are there. But if it's 100% guarantee, no way. So don't focus on finding out the right entry because that's not the whole point. You want to be successful in trading, you figure out where to get out first. Where's your stop loss? Where's your take profit level? And then you figure out your entry. And then you decide based on comparing your entry to your stop loss and your take profit, what's the risk to reward ratio? Okay, maybe I'm risking 10 pips, but I'm gaining 100 pips. Oh, that's a really great trade. I don't mind that because I'm only risking 10. I'm gaining 100. Wow, that's 1 to 10 risk to reward ratio. That's crazy. All right. Entry is important. I'm not gonna sugarcoat it. Entry is important too, but entry is important if you have compared it to what you can afford to lose. Otherwise, it's rubbish. What determines success in trading is basically your discipline, your planning, and getting out of the trade. When to get out. Okay, until the moment you enter into a trade, you are still in control. So make sure you do all this before you open a trade, because once you start that trade, the market will basically dictate where the price will go. It's not you. You're not going to tell the market to go. You're not going to tell the pound to go up right now because I got in right now, right? No. If you got in long, if you buy pound, and then the market turns around and smash you in the face, whose fault is that? People are just gonna blame the brokers. People are just gonna blame the people that tells you to trade, people that do the analysis for you. I've been an analyst myself. I basically get the blame because it's not 100% for me. My probability is 70%. What are you going to do? 30% of the time, there's going to be losses. And all these people all remember just the losses and they just complain. Instead, why not figure it out and ask yourself? You're the one that's in control. Whether you want to get into the trade or not, that's completely up to you. No one's forcing you to do so. So, you cannot control this, just as you can control with 100% certainty what amount of gain or loss that's going to be made, right? We did an outlook. We were talking about strategies this morning. There was about 5 trades that we took. Okay. On my side, I'm profitable about 1,000. I'll show you in the account later on what we did. But to some people out there that might have a different lot size that they trigger, that's a completely different story. Okay, so I don't know what amount of exit or stop loss that's going to give you. If the market decided to, hey, market's going to turn around now, there's a support at the bottom there, the market cannot go any further, I'm selling something, I need to get out because the support is there. So sometimes we need to do that. And that's minimizing your losses and protecting your profits through a defined exit strategy. So you need to have a plan A and a plan B, or sometimes a plan C on what to do with your trades. Now, with a trading plan and careful calculation of position sizing, the risk of taking a trade can be calculated, and I always do that before I open a trade. I'll always calculate how much I can lose and then I'll ask myself the question, am I willing to lose this? Is it worth it? Okay, if it's not worth it, I'll just bypass the trade. I don't like randomly listening to people saying, oh, buy this, buy that. I don't know. You guys read the news. People keep saying, the analysts keep saying, all right, time to buy this, time to buy that. When it reaches the news, that's basically old news. Okay, when we have the chart in front of us, when we have the data in front of us, when at release, we know what the data is and we can digest that data. We don't need to wait for the news. When it comes to the newspaper the next day, whatever, there's no more newspaper, but on the websites, for example, CNBC, they're always late. CNBC, they always overblow their negative stuff in the media. Bitcoin dropping by, I don't know, 4,000, dips down below 60,000. They were saying, oh, Bitcoin just crashes. Look at where Bitcoin is right now. What is a drop below 60,000 for 1 minute? But the news media outlet are just gonna amplify that for you, and by the time you hear that, it's always too late. Okay, so always look for an exit again that matches the capital limit that you set aside yourself, and also the trade risk limit that you already have set aside and predetermined in your trading plan. In essence, the ideal exit should provide you with these three things. Number one is to minimize your losses. Number two, to maximize your profit. That's a duh. Okay, minimize your losses, maximize your profits. Number three is to limit the amount of profit you give back to the market. Okay, the point is you do not want to overstay a position. This was a question that was asked yesterday. How do I not overstay? Because people overstay for one good reason, and that's just pure greed. If they're in profit, they think it might go higher. You know what happens? And this is something that you guys probably have experienced if you guys have been trading. You think it's gonna go up, you should have got out, you didn't get out, the market reverses on you. Instead of a win, you get a loss. Okay, number two is also avoiding entry because of fear of previous failures. Now, when we talk about trading just now, I mentioned consistency and discipline. So you got your 2 consecutive losses. Your probability of being correct is maybe 40%, 60%, I don't know. So you got to calculate that out of 10 trades. You don't just take 2 consecutive losses and then you miss out on all the other 8 losses, the other 8 trades that could be a winning trade, but you didn't take it because you're afraid. Okay? So that's what happened when you don't have a trading plan. And the purpose of having a position sizing is basically to alleviate these factors that are beyond our control, such as unexpected market movements or our mental failure to handle past losses that may have caused trauma. Look, I have to do counseling for traders. I have to teach traders the psychology of trading. That is part of my curriculum. So that is actually something. People are actually afraid of triggering a trade. That's going to impact their performance as a trader, and that's a real thing. Okay. Oh, that's a mouthful. Okay, so we got rid of the risk management side. We got rid of the boring side. We're going to take a look at the fundamental analysis. When we talk about fundamental analysis, there are actually basically 4 things to look at. You got your macroeconomics. Okay, that's the global economics. Microeconomics, which is your country's economy. You got your monetary policy, which is every country has their own monetary policy. Fiscal policy, which is policy that's ruled out by the government, which is basically your taxation policy, their annual budget policy, whatever. That's fiscal policy. Monetary policy is interest rates, typically, whether or not printing money or stop printing money. So those are 4 key fundamental analysis that you need to look into. We're not going to focus on a lot of those in this webinar because that's technically impossible. You need to go to uni and take economic classes if you want to figure out all of it. Okay, and that's probably why a lot of people are more attracted to technical analysis, because even though I have a degree in finance, not a lot of people can just get into economics and completely understand it. Okay, it's a mixed bag of things, but I'm gonna try and summarize things for you that you focus on. Okay, so here are your key economic data in Forex. Number 1 is retail sales, which is what happened yesterday when we were doing the workshop. Okay, There are two parts of retail sales. Number one is retail sales. If you take a look at it, retail sales, and then there's core retail sales, and then there's one that says MM at the end of it, or YY at the end of it, month to month, or year on year, or Q is basically quarter. So you need to take a look at this. Retail sales basically is spending on consumer retail products. That would be your clothes, the department stores, performance, food and beverage consumption, electronics and equipment, furniture, gas station, car dealer, or car sales. Those are all combined and then average to form your retail sales number. Okay. The core retail sales to me is much more important because core retail sales data excludes cars and petrol. Now, you know, gas prices, oil prices are pretty volatile. So basically by removing that, it removes the volatility caused by gas prices and high ticket item sales like a car, which is a lot of money, right? So we focus more on the core retail sales, but generally as a whole, we look at the economy's performance through retail sales and their core retail sales. They'll come out together hand in hand. Okay. So basically a decrease in retail sales will basically result in a decrease in GDP, gross domestic product, which we're going to cover later on, due to a decrease in purchases, which is a decrease in taxes received by the government as well, right? You don't pay your VAT, you don't pay your GST, you don't pay your whatever your country calls, okay, which is consumption tax, goods tax, and services, goods and services tax, okay? A drop in retail sales basically typically equates to people saving their income, and this is an early indicator of employment numbers. Maybe people are not working, they don't want to spend too much, okay, they're trying to save because inflation in the market, because goods are getting more expensive. So this is a good early indicator of those two, employment numbers and inflation numbers, which we are going to touch on later on. So the next one is CPI, Consumer Price Index. This is your inflation guide. Okay, the CPI is up. That means inflation in the market is happening. This is basically a measure of the price of basic necessities. This is your toothbrush or your rice, whatever. Okay, your soap. This is your CPI, your Consumer Price Index. If it's high, if it's too high, then it goes into inflation. And then there's hyperinflation. And then there is, if it goes down, then we call it deflation, obviously. Year-on-year data is used as a benchmark. Okay, but quarter-on-quarter data is also used as an indication of potential changes in the inflation numbers. CPI numbers are great. CPI numbers are market moving. However, we discussed this in my Telegram channel. Fundamentally speaking, this is currently decoupled from the US economy. They're not really focused on the inflation numbers to decide on whether or not the interest rate is going to change. So that's going to give 2021 a little bit of a difference in how CPI is performing. All right. Employment numbers. This is the big one. This is basically what's going to destroy people or make people rich every month. Okay. This is the US non-farm payroll numbers, or basically your non-farming employment rate. Okay. That's basically an addition of how many people, how many thousand jobs that's created in a non-farm environment. This is obviously non-farm, excluding farming. Following the NFP release, the unemployment rate is going to get released at the same time as well. This is released every first Friday of every month, regardless of whether it is a holiday or not. It just happened last 2 weeks ago. It was Good Friday, and NFP was released on that Friday. On a Good Friday, when all the other countries are having their holiday, the NFP numbers came out. Okay, this, let me warn you, is the most volatile news release in the currency market. Okay, you can either make it big really quickly, or it can destroy you in one night, less than one night. In fact, it'll only take 15 minutes to destroy you, or 15 minutes to make you super rich. So I'll say this is not for beginner traders. If someone tell you, oh, you should be trading the NFP, you're gonna make a lot of money. Okay, again, is a good way to make a lot of money. It's not. NFP is good for beginners. It's not. It's for advanced traders only. Okay, it's a specific club. Once you get into a high level skill of trading, then you should be able to trade the NFP. Otherwise, please stay away from NFP. So it really requires you to have a good understanding of market behavior during the NFP to successfully trade it, not just from a technical analyst perspective, not from fundamental analysis perspective, but you need to be able to understand the behavior of price, of the sentiment, of the psychology of the market during this news release. Here's another problem. When you see NFP came out, typically it'll create a huge spike in the market. It'll increase your spread. It will slow down your execution speed. You can get in, or maybe you can't even get in and you cannot even get out. So be very careful. It's super volatile because of the volatility. Liquidity dries up. The spread gets bigger as well. Your cost of trading is huge. The market just moves really quickly. Okay, so employment numbers is something to watch out for. In fact, this is probably the most watched news in terms of Forex and equity trading, but mainly Forex. Okay, so NFP is not for beginners. Please let me warn you again, it is not for beginners. All right, next is manufacturing numbers. We have your manufacturing PMI, which is your purchasing managers index, manufacturing sector indicator, which is your ISM. Manufacturing PMI in the US is monitored by traders. I'll typically let me give you a breakdown of it. If it's at 50, then it's neutral. That means it's okay, it's stable. Above 50, expansion in the manufacturing sector, which is an expansion in the economy. Less than 50, that's a contraction in manufacturing. A lot of people that are focused on the Chinese market are actually going to focus a lot more on the manufacturing side. That's the most important data that comes up from China. But US sector as well, that's something that we look into it. But the number is 50. If it's around 50, then it's close to neutral. More than 50, that means there's expansion. Let's say it's 60, then obviously it's a bigger bullish news. That's good, right? Less than 50, it's a contraction in the economy. Basically predicting a recession or expansion in the economy, as I mentioned, simple as that. Nothing too hard, obviously, because this is basic fundamentals. All right, next is interest rates. Okay, so central bank interest rate outlook. Globally, we talk about interest rates. Okay, there are impacts on government treasury bonds, obviously, straight into that, because they are related to yields, which is again interest rates. The change, for example, in the US 10-year bond yield curve is a leading indicator of a country's economic turnover. I believe every country have their own treasury bonds. I think they call it the Bund in the UK or Germany. But typically we look at the US 10-year treasury bonds. So a reduction in interest rate, in essence, basically weakens currency. Import price will rise. The problem right now here, after the global financial crisis happened, a lot of the world are basically at 0.25% or 25 basis points in terms of interest rates, or even zero or negative interest rates. Okay, so it's not something that we are too concerned about. We are more concerned about what the central bank says, not what the changes in the interest rate is, because typically right now, especially with COVID, they're not going to raise interest rate yet in the near future. But what they say every month, that's going to be important. Okay, if you see an increase in interest rate, it will strengthen the currency because your export prices are going to rise. Obviously, you're gonna the country is going to earn a lot more money. So treasury bond yield curve are normally negatively correlated to the bond prices. So if bond prices goes up, the interest rate or the yield curve actually decreases. For example, the yield recently on the US spikes up, the US dollar gains strength. That's basically that. Okay, that's what we want to focus on. The US Treasury yields, if it goes up, the USD goes up as well with it. All right, this is, I'm going to skip one slide, but I'm going to go, this is the 10-year Bund on the German. The comparison is on the euro. The euro is on the purple line there. The yield for the 10-year bond is on the yellow. Okay, this is yield, not price. So this is the interest rate. Obviously, you can see that they go in the same direction. And this one here, the green one is the dollar yen. The blue is the US 10-year treasury yield. So you can take a look at the movement. It's pretty much right around the same. So you can use this as a guidance. We'll talk about this more during correlations, okay? But this is just to give you an indication. Someone was asking is if US treasury yield actually affect the market. Yes, it does affect the market, okay? All right, last one is GDP, which is your gross domestic product. Fair enough. Okay, this measures the level of economic development or contraction of a country, which is a country's economic health. Okay, this is how other countries are measuring other countries. This is how other countries measure another country's economic condition. So it's an economic valuation of a country. It measures the standard of living of a country. As the GDP increases, therefore the standard of living will also increase. Because if you take a look at what it is, GDP is equal to your consumer spending, which is your retail sales number, right? Your government spending, business capital spending, the net exports, which is exports minus imports, combined, that will become GDP. Now, there's what we call a technical recession. That's basically 2 quarters of GDP depreciation. That was before 2020, and then 2020 happened, everything is off. Okay, right now in the US, this is not the formula anymore. Some of the country are still following this formula because they don't know what to say, or media outlets are saying that because they're not educated or they're not informed that a lot of the countries out there are no longer following these rules where there's 2 quarters of GDP depreciation. Then they call it a technical recession. It's no longer the case because of COVID-19. All right, there's a changing economy right now that's going on. There's different way of data collection, right? Like retail sales, they don't even count the online sales number. You know, you got your pandemic. Also, the way consumer spends in the past month, past year is different. America has not adopted the 2-quarter method of establishing a recession. So this is no longer available, and this is being followed suit by a lot of countries out there. They're moving away from this formula because it's no longer accurate, it's no longer relevant to the current COVID-19 pandemic situation. So keep that in mind. But we still look at GDP numbers. If the number is good, then the economy is healthy. If the GDP numbers increases, then it means we know the economy of a country is recovering. Okay, so we've seen this. We'll skip that. All right. Whew. We've got 30 minutes. We still have a lot of content. Team Okta. I'm very sorry, but I think we might have to go a bit more than the next 30 minutes on this one here, because we're going to talk about volatility next. People were asking what time should I be trading yesterday, so I decided to drop this in. These are basically your hubs. We call them hubs. Basically, they are your what do you call it, your stock market, you know, where the markets are being traded and whatnot. We have the Chicago and New York in the States, and then we have London and Frankfurt and Paris, okay? And then in Southeast Asia, the main one is Singapore, Malaysia and Indonesia. I'm sorry, you're not considered there on a global level yet, okay? For Asia, general Asia is there's actually 3, which is Hong Kong, Shanghai, and Tokyo. Kospi as well, but following the global financial crisis, I think Kospi has lose a lot of favor there. In the Asia Pacific region, Kiwis, I'm sorry, you're not part of it. It's Sydney, it's Australia, the ASX 200. Okay. All right, so let's talk about time zone and volatility. So this is something that you need to figure it out, because I asked you earlier at the beginning, where are you guys from? Because that's gonna affect how you're gonna be trading. So what does volatility do? Okay, volatility, we talk about this, it basically what moves the market. If there is no trader in the market, then there's not going to be any volatility. And then there are what we call dead zones, and this is what we've been practicing in the Bahasa Indonesia Telegram under my channel. Take a look on the Telegram channel if you want. I posted something about this and the performance of what happened this morning. But there are what we call dead zones. These are basically Asian sessions. Asian sessions is not good for currency trading. For European currencies like the Euro, USD, the Pound, it's what we call a dead zones. Okay, it's active for Japanese yen. It's active for Australian dollar, New Zealand dollar. That's fine, but it's not active for Euro, USD, GBP, USD. It's not really good. Okay. Likewise, there is going to be a dead zone for Asian currency, which is 2 hours after the European or London Open. The reason is the market is closed. Now, volatility rules of thumb. When the market open, the volatility will increase because there's market participant that just woke up and just start trading during the day in the morning, right? So the more the merrier. Like I mentioned before, we have the Easter holiday last week. The market was closed during the holiday. There was an absence of volatility. Market didn't really move much, or there could be an exaggerated volatility because someone with a lot of money can actually push the market around. So you need to be looking for relevant financial hubs to trade the instrument that you want to trade. For example, trade the Aussie USD during the Australian market session. That's a given, right? Trade the Indian rupee when the Indian market is open. That's a given. Trade the Indonesian rupiah when the Indonesian market is open. That's fine. Okay. Trade the Euro USD during the European or US session, because why? We have the Euro and then we have the USD part in it. So European US session overlap. That's where Euro USD is active. That's basically at the beginning of the US session. That's where you see volatility increases on the Euro USD and the GBP USD. All right. Volatility will also increase with uncertainty. If you want to know, that's actually an index. It's called the VIX, or the volatility index is VIX. Okay, you can look up on that. Here's what makes things different. This is what I asked on the first webinar, whether you're an investor or whether you are a trader. Because as an investor, you don't want a market that's volatile, because you don't know what's going to happen in the future in the long run, right? But for traders, we want high volatility because we can get in and out quickly. All right. Stability means the market is going sideways or it's in a narrow range. Uncertainty, it gives you a wider range. That means you can get in and out quickly, or maybe print a higher risk reward ratio quicker. As a trader, we want higher volatility. As an investor, we want lower volatility. Okay, just keep that in mind. Low volatility is good for investors. High volatility is good for traders. All right, then we take a look at the market range, which is dependent on a financial instrument. Let me just give you an illustration. The dollar yen, the euro pound, the volatility is a little bit low. The range gets smaller. The pound USD, the sterling yen, the volatility is higher. The range is bigger as well. So instruments with lower liquidity and market participants tend to be more volatile. This is again mentioned in the first one, the exotic currencies that we talk about. And I say if you're a beginner, avoid exotic currencies. Okay. So that's volatility in a nutshell. Now let's take a look at technical analysis. I'm trying to go as fast as I can right now. When we talk about technical analysis, there are actually two things. You might not know this. Maybe you just think, oh, technical analysis is just one thing. No. Like fundamental, we have four things: micro, macro, fiscal, monetary policy. Technical analysis has two things: price-based analysis and indicator-based analysis. We're going to go in depth later on, not in this beginning webinar. But for tonight, I want to touch on a little bit about price-based analysis. All right, so what are some examples of price analysis? We have your trend lines, okay? We have your chart patterns. You got your Elliott wave theory. You got your harmonic pattern, which is the Gartley and the butterflies. Fibonacci-based analysis. You got candlestick patterns. We talked about candlestick patterns on yesterday's video. Renko, we just finished that for the Bahasa Indonesia one. Gann analysis, Ichimoku, we just finished that for the Bahasa Indonesia as well. Pivot levels, we're looking forward to pivot levels coming out in the future on a separate webinar. But when you look at price analysis, It says it there. You're analyzing price movement. Okay, indicator based analysis, that means you rely on the indicators for your analysis of the market. Couple of advantages and disadvantages here on just looking at price analysis. Advantage, you're quick to react to price changes. There's not going to be ambiguity in there. You don't know whether it's right or wrong. You got your precise levels to work with, especially if you do your Fibonacci, which is on a separate webinar, by the way. If you look at price, that means you are getting a precise exit levels laid out in front of your eyes. And it's easy because for beginners, you can just set and forget about the trade. You set your stop losses, set your take profit, open a trade, let it run. Okay. The disadvantage on this is that there's not a lot of entries. If you miss one breakout, then you're going to miss out on this. Now, depending on the strategy you use, price analysis entry is mostly not optimal. Okay. And the third point is probably the most important. You need to have a high level of discipline and trading mentality is required, which is what we're going to cover in the future webinars, specifically just on the discipline and trading mentality, which is psychology of trading. Okay, it can be subjective. Again, if you have your trading bias that you insist you are correct, then it can be subjective if signs are not obvious or rules are misunderstood. So I'm going to show you something tonight that is basically how to draw a trend line. You might think, oh, that's stupid. Trend line is easy. No, trend line has rules. You messed up the rules, you're not going to get it right. Okay, so drawing a trend line, really going back to basic here, for me at least. For you guys that are new, this is your first step. Okay, 1,000 ways to Rome, always begin with a single step, right? And this is your first step. You understand how to draw a trend line correctly, then you're set. Okay, that means you're in the right track. So a trend line is not just a random scribble on the chart. You cannot just say, oh, this is a trend line. I just draw a line and say it's a trend line. No, there are actually rules to follow when drawing a trend line. And trend lines are there, as the name suggests, trend lines. It provides you in terms of guidelines of where the trend is going. Is it an uptrend or is it a downtrend? So it can both be a support or resistance trend line. And most of the time, these trend lines are sloping. We'll get deeper into the degree of trend lines in future webinars. We are not going to cover that here. We don't have enough time for that. But the degree of the slope indicates a trend strength. Okay, if it's close to 90 degrees, that means the trend is going to go really quickly, but it's going to get exhausted quickly. 45 degree and 30 degree is ideal. All right, so how do we draw a support trend line for an uptrend? What we want to look for is actually swing lows on the chart, and you want to connect the low of a swing, not an open or a close, but the low of the swing. Okay, and for a trend line to be valid, it has to connect through 3 swing lows. This will indicate that there are going to be more buyers than sellers in the market, like this chart is going to show you. There's a line there, and how you draw it, you connect 2 lines, and once it's connected at 3 points, you have a confirmed trend line, and then it will work as a gravity for price. Look at how price revolves around the trend line. It'll try to go back to the trend line. It'll try to retest the trend line if it's broken, and so forth. Okay, so for resistance trend line, which is a downtrend, we want to look for the high. So this one here, we look for the lows, right? You look at the lows right around July there, and for this one, we want to look at the high, the swing highs on the chart. Remember, it's not the open or the close, but the high, the highest point the price has managed to reach. We talk about this in candlestick, the open, high, low, and close. There was that wick there. If you missed out on yesterday, please don't ask me here during this session. Please watch the video again, the recording after this session, and you'll find out what I mean by open, high, low, and close. All right, so this is a resistance trend line. See what I did there? I just connect 2 swing high and it'll do the rest for me. Okay, we'll know it works because the third point is the third circle over there. You see how price is trying to break above it but fails to do so. Okay, eventually it does break it, but what happened there at the end of the chart is it's attempting to go back and touch that trend line one more time. Okay, so that is the basic rule of how you draw a trend line. You don't just randomly draw it. Okay, if you cannot get this right, then I can guarantee you your future analysis on price is going to be wrong. Okay, so do not connect the open or the close, but always the highest point or the lowest point, depending on what you want to draw. All right, so that's trend line. Now we talk about support and resistance. Okay, support and resistance is what we call a significant price level. This could be a psychological price level, which we're going to touch on next. A Fibonacci level, which we're not going to touch on in this webinar because it's on a separate webinar. A pivot level. If you are an equity trader, you are going to be familiar with pivot level, but otherwise we're going to be doing that in the future as a separate webinar. But again, previous failures or bounces. So you'll see a cluster of price that's unable to break a certain price level. Okay, but I'm going to give you a shortcut because those clusters are typically right around the psychological price level or either a Fibonacci level. Okay, this Fibonacci, if you're not familiar, we draw from point A to point B to draw what we have here, which is the Fibonacci retracement and extension levels. Those that speak Bahasa, you guys have done this with me, I don't know, 2-3 times. It should be drilled into your head right now in terms of how you use Fibonacci. We even go for advanced Fibonacci levels. But for those that are English speaking, I haven't gone through Fibonacci levels in English, but we might be able to do that in the future very soon. Okay, this is Fibonacci levels, and take a look at this one here, the 161.8, for example, the 78.6. Price respects this level. Okay, supports and resistance. Take a look at the red circles. Okay, the line 1.0525. Keep that in mind. Okay, 1.0525, because we're going to talk about 25 soon. 4 times it fails to break above it. Once it's broken, it comes back to retest it. So this is what we call previous support and resistance. What has happened in the past is going to be your reference in the future. So this is key. Okay, so this is just a plain horizontal line that you can look, you draw, you see how price react to that level. You reject it 4 times, breaks through, come back, retest it as a support, and then it bounces back. Okay, this is where the term rejection and bounces comes into the market. Okay, so let's combine, horizontal support and resistance as well as a trend line. So we got trend line drawn, and look at what I did with the trend line. At those 2 swing lows that I drew the trend line from, I drew a horizontal line, and here's what happened to that. When price breaks a trend line, the first support that it comes to was actually the previous swing low that creates a trend line. Comes back to retest the trend line, unable to go back up. It goes back to the second support level that's there. Once it's broken, notice what it does. Price actually comes back up to retest that trend line again. That support level there, now it becomes a resistance. Okay, so that's how it works. It's simple. Now let's talk about psychological price level. I mentioned the 25 numbers just now. Okay, psychological price level is real because let me give you an example. If you have an apple, what are you going to do with the apple? How are you going to cut that apple? Or if I give you an orange, how are you going to cut that orange? You're going to first cut it into half, and then once that half has been cut, you're going to cut it into quarters. Okay, this is where this is what humans do. This are conditioned to us because we want to make things simple, equal. Okay, I don't know, maybe some of you that can comment, maybe some of you think differently. Maybe I want to cut an orange into 8 pieces immediately. No, but the first cut that you do is typically right in the middle of that orange to cut it into half, and then another half to create quarters. Okay, this is what humans are conditioned to do. These are what we call psychological levels. Price levels that ends with 00, 75, 50, and 25. Okay, support and resistance levels are often found in close vicinity to this level. So let me just go back to this one here. This is at 1.0525. 05, 25. So we look at the 25, right? So again, over here, if you take a look at the top there, 1.3390 is actually closer to 1.34 if you look closer in the chart later on. Okay, so psychological price levels are there. They are the 00 that ends with 00 that ends at 75, 50, and 25. So for every 100 pip to create a cent, it will actually potentially stop 4 times at 25 pips, 50 pips, 75 pips, and then 100 pips. That's where your 1 cent is. Okay. So here's an example of the psychological price level. What I did there is simply just drawing 1.705, 1.7025, 1.7, 1.6975, 1.6950. Take a look at how price react. These psychological levels where they're rejected are typically around the psychological price levels. And the resistance and support trend line, the resistance, previous support and resistance are created. Take a look at 1.7. Focus on 1.7. It becomes a pivot. It becomes a level where traders are psychologically conditioned to think that 1.7 is a very important key level, as either as a support or as a resistance. All right. Let me grab a quick drink. All right. Chart patterns. Okay. There are a lot of chart patterns out there. This is part of price analysis. Most commonly used chart patterns are triangles, pennants, flags, and wedges. These are used to measure market sentiment, to time an entry, and detect reversals or trend continuations. In this session, we will focus only on triangle because we only have 30 minutes left and I have to open up the room for Q&A. So we might run a little bit late, but let's do this. For example, chart patterns are there. If you notice it, if you take a look and you understand what's going to happen, we have a specific webinar for chart patterns as well. You can take a look at chart patterns actually appear quite a lot. We have the trendline resistance, which is part of the chart patterns. That's going to form a triangle. Then we have one that's a bearish flag. We got a broken trend line followed by a triangle. So chart patterns are basically everywhere. And triangles is basically where price is always in. Price is always within a triangle. It's just depending on what time frame you look at, but price technically is always within a triangle. Okay. So triangles are basically formed by support and resistance trend line. That's why I focus on how to draw a trend line correctly, because if you can draw a trend line correctly, then you can draw a triangle correctly as well. So basically there are 3 variations of triangle. We have the ascending triangle, descending triangle, asymmetrical triangle. A triangle again will exist at all time frames, at all times identified through different time frames. So this can be used as an entry or exit into the market. So again, they are everywhere. You can take a look at these triangles there. See how triangles are formed by drawing a support trend line and resistance trend line. They are everywhere in the chart. The first one we're going to touch on is ascending triangle. This is a bullish triangle. It's commonly found in an uptrend, so it's a continuation pattern. So it signals a trend continuation that's going to happen. What it looks like, it has a horizontal flat top, which is considered to be an overbought condition. But the sentiment is still bullish and buyers continue to buy on dips. That means every time the market goes down, buyers come in to pick it up. That's why it'll create a sloping triangle that goes up. And it again commonly occurs around psychological price levels, artificially capping the market horizontally. This is what it looks like. If you take a look at the ascending triangle there, we have a flat flat resistance, and then we have a trend line that goes up. So every time it gets rejected at that horizontal line, buyers come in and buy it at a higher price. It will create a sloping trend line. So it will normally appears when the market is trending up. It will indicate a trend continuation. So this is not a reversal pattern, but it's actually a trend continuation pattern. Notice that the market has been going up, then it goes sideways, and then it forms an ascending triangle before it breaks further higher. Again, failure to break above resistance is not a sign of reversal, because it could form into other things. It could move into a sideways channel, which I don't think we have enough time to talk into, but this is what ascending triangle will look like. The opposite is a descending triangle, which is bearish. It's commonly found in a downtrend. It will signal trend continuation to the downside. It has a flat bottom, which identifies an oversold condition in the market, but the sentiment is still bearish and buyers will continue to sell on pullbacks, not buy. It's a typo there. Commonly occurs around psychological price level, artificially supporting the market horizontally. So this is what a descending triangle looks like. Notice how it forms 2 times. And every time it forms, notice the middle one I didn't mark it because that's what we're going to discuss next. That's the symmetrical triangle. But look at the formation of the descending triangle. 2 times. It breaks. Trend continues to move to the downside. Breaks again. Continues to move to the downside. Okay. So the next one, which is the one here in the middle, which is what we call the symmetrical triangle, it's neutral. It basically signifies this indecision in the market. It's like doji that we discussed yesterday. Buyers and sellers has equal strength. That's why you look at the slope. One is pushing down, one is pushing up on the trend line. But the range will gradually get smaller. And people don't like this because it creates uncertainty in the market, right? And one way or the other, it's going to break. Volume and volatility will also diminish as time goes by. Most of the time, the original trend will continue. So it typically becomes a trend continuation pattern. However, because this is a neutral sign where there's uncertainty in the market, then this could also be a reversal in the market. Okay, in this case, this is a continuation pattern. This is a symmetrical triangle. Take a look at the shape there. It's not horizontal. Both are sloping. One is sloping up, the other one is sloping down. If you draw a trend line that slopes down and a trend line that goes up, it will eventually form a triangle. Okay, so this is why drawing a trend line correctly is important, because that's basically how we look at forming a triangle. Okay, so in summary, triangles are basically one of the best trade entries based on price, and the momentum during breakouts are almost always a move in one direction because it's strong. Being close to support and resistance during breakout, risk to reward ratio are generally small and favorable to you. Tips for trading triangles: wait for price breakout of ascending or descending triangle. I like ascending and descending triangles more than symmetrical because it gives me more certainty, because it gives me a trend continuation. Due to the logic behind profit taking and position adjustment, oftentimes this price will come back to test the broken support and resistance. You can wait for that to happen before you start entering it. By doing so, you'll actually reducing your distance from your entry to your stop loss. Okay, the range of the triangle will always be the initial target of a triangle breakout. Okay, so in a nutshell, the question that you're gonna ask me next is, why do you think price action work? Because market movements are influenced by traders. Price movements are influenced by how traders think or how traders value something. Okay, fear of failure around psychological price level is a strong influence as well, because we are psychologically conditioned to be afraid of a certain level. Okay, profit taking around these levels are very common, giving an illusion of stronger support or resistance. At the same time, traders still want to ride the trend, hence the continuation once traders are assured that a certain level has been taken care of. That's where you see your descending and ascending triangle. Counter trend traders, on the other hand, hopes for the flat horizontal level to work because they'll just bounce in and out of that. Therefore, going against the trend, I have stops lined up just beyond these levels. A breakout occurs because these stops accelerate price movement. So let's take a look at this one here. Let's say you have a flat horizontal line. You know what happened there? A lot of people are putting their stop losses just below that below that horizontal line. Okay, once price break through it, it's going to trigger a lot of that stop losses, which is basically closing their buy position and triggering further sells. That's going to increase the momentum to the downside. Okay, so that's why breakout, when it happens, it's really powerful. Okay, so we're going to wrap things up very quickly. In summary, charting relies on past information to predict future support and resistances. There is no better leading indicator than price action itself. Price takes into account trader sentiment and psychology, which is very important, and I've been mentioning that a lot. Charting also assumes that any fundamental views of the market is priced into the market. Key aspect to successfully utilize chart information is to predict what other traders are thinking and looking at. It's not about what you think, it's about what other people are looking at. It's about what other people are thinking about. Okay? Every tradable instrument has their own specific characteristics and price patterns. We will discuss this in a separate webinar, but basically, for example, the dollar yen, the euro pound, the pound US, the pound yen, they have different volatility, they have different range, they have different behavior. Okay, that's why I say don't trade the non-farm payroll if you're just starting up, because you need to understand these behaviors that is not easy to pick up in one go. All right, so thank you, and we're gonna open up the Q&A session. If you want a code there, that's beginner INT1, and I'm just gonna minimize my face there so you can take a look at the promo code. I'm gonna take a look at the Q&A session next, and see what I can do. Any questions that you have? I know it's a long session, it's draining you, but bear with me. This is nothing compared to what's waiting for you if you want to take this further. All right, take the blue pill or the red pill. All right, so Malik Usama asking who I am. Hopefully you figure out who I am. That's good. Okay, how do I start? Okay, OctaFX team has given you a link there for you to get started. Okay. All right, good. A lot of beginners here. That's good. You can watch it again after this session. It's going to be recorded. That's going to be made available after this session. Once I end the stream, I think that's going to be available within the next 5 minutes. Okay, there's a lot of new traders here. That's good. All right, learning a lot. Thanks to Kudos. This is happening during your work hour. I'm sorry here. There are definitely people from different time zones, but this is going to be recorded, so that's completely fine. You can rewatch this again. That's fine. Account open. Could you please add me in Telegram group of Mr. Vito? Okay. The Telegram group that I run is in Bahasa. If you can speak Bahasa, please feel free to add Miss Priska DZ into it. That's going to be great. I have no idea what it's a Cadila 540 CE, and I'm not here to help with your trade, because you should have figured out what that trade is before you open a position. Okay. How can we know what volatility is high or not? There's there indicator to see this. Yes, there is. It's called the VIX index. If the VIX index is, I believe 19 was the number that people are afraid of. If it's above 19, then if volatility globally is going to get higher. After the pandemic session, Asian session still considered a dead session. Yes, it is still. Population in Asia are higher, that make volatility higher too. Doesn't mean that every Asian trades, right? It's like saying every Asian knows martial arts. Not all Asian know martial arts. Okay, and that's pretty scary, man. I mean, if you say the population is higher in Asia, it is still considered a dead session, because no one really focus on the Asian currencies. And let me give you a reason why. Because Asian currencies are developing countries, most of them, and the currencies are considered exotics. No one touches them. And most of the Asian currencies, like the Chinese yuan, is more of a controlled float. Singaporean dollars is pegged. Hong Kong dollars is pegged. Indonesian, I believe, is also, they say it's a free float, but to me it looks like a controlled float. Okay. Some says that better trend lines are made on a line chart. No. Who said that? Do you know what a line chart is? If you don't know what a line chart is, let me tell you what a line chart is. Okay, let me just pull up the thing. A line chart is one SMA, which is a one single moving average. Look, I'm just gonna add this for you, okay? Just to be sure. Whoever said that, I don't know. First of all, how are you gonna draw a trend line with a line chart? Because line chart is an average. How are you gonna draw a trend line? You wanna take this point there and draw it there, up there, like that. And then how do you know that's a breakout? Okay, if I switch this to this, that's off. You see that? That's the open and the close. We adjust it there. That's okay. It works. Okay. But the line chart will take the open and the close because it's an average. Look, I'm just going to drop moving average in. I'm going to do 1. Okay. I'm going to make this super thick dark blue color. Actually, no, I'm going to make it red. So it's obvious. All right. Simple. Moving average 1. And then I'm going to switch into a line chart. See that? It's exactly the same. It's one simple moving average, and you cannot take a trend line through a moving average because, again, it's an average of price. Obviously, it's not going to be accurate. It's easy to look at where the market's going to go. It looks like it's going to go up. That's basically what it's for. That's basically what line chart is for. Okay. Yeah, I nearly forgot. There's an economic calendar up here. If you want to go to analysis education on the website, there's economic calendar. Click on that. This is what's going to happen depending on where you are right now. Wherever you are, you can just type in wherever you are. That's going to adjust this releases into your country. For example, let's take India. For example, no result for India. Okay. Nigeria maybe? Nope. Okay. No. Okay, I don't know. GMT. Say Singapore is what? GMT. Beijing, Hong Kong. All right. GMT 8. That's gonna change it. Then the green quotation mark. That's basically not important. That's medium importance levels. I can filter that, or I can just go for the higher impact one, like this one here. You can filter that out. You can then change for what's on today, what's on tomorrow, what's on this week. I like the weekly one because I know what's going on. Okay, that's great. Okay. After pandemic, blah 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 blah. Yeah, same question. What do you think about crypto? I love crypto, but not all cryptos. Albert, I know what you're trying to do here. You already asked me this question this morning. Will there be any webinar explaining further trend lines, Fibonacci triangle for further case studies? Mr. Ho Gim Beng, I believe we are going to be doing that. I don't know if it's going to be me or some other speakers from the team that's going to be doing that, but definitely we're going to be doing that. What makes spread to increase excessively within a few seconds? Typically it's volatility or high impact news where liquidity is not available or not easily available, like the NFP. That's going to dry up liquidity really quickly. If people just try and open a close position in one direction, that's going to dry up the liquidity. How can we judge that the market will go down or up? That is why we need to learn the technical analysis or the fundamental analysis. We don't judge. Judge is an opinion. We want to be more or less non-subjective. We want to be objective in our view of the market. That's how we look at things. Okay. So Vinod Kumar, we are gonna be doing more educational webinars. That way you'll understand how to look at the market maybe a little bit better than what I've been explaining today, because this is more like a crash course. All right, I think we're a little bit of over time right now. Is there any further questions? If not, let's go back. This is the code beginner INT1. That's for your 100% deposit bonus, I believe. Yes. Let me just check that. That's a promo code for 100% deposit bonus. And the bonus is given to everyone who sign up for the webinars and watch them. Okay. Remember again that OctaFX will only work under its official brand name OctaFX and will only process payments through your client profile created on the OctaFX site, trading app, or the OctaFX copy trading app. How do we get more of your educational costs? Because it's well explanatory. That's lovely. If you like what I do here, give a thumbs up, subscribe, click on the notification bell there on the channel, and also contact customer service that you want me to be doing further webinars that explain things a lot more in the future in English, because I've done most of the stuff in Bahasa, but we haven't done a lot in English, but that's going to change soon. We are definitely going to be doing a lot more educational webinars in English. We're going to cover a lot more like Fibonacci and whatnot. Team OctaFX, could you please help out with Habib on this one? Fibonacci retracement used only for N3 and exit. That's not gonna get answered here. Don't be tricky. Okay, we're gonna have a separate one over there. Fibonacci, we use it for a lot of things, so it's not fair to just answer a yes or no question here for you. All right, anything related to the topic tonight that we discussed in terms of triangles, price action, the risk management side? If you got any questions, position sizing, I think we covered quite a lot and it's pretty intense tonight. I am from Australia but stuck in Indonesia right now. Okay, look, a lot of people are going to be asking, where is this guy from? He looks Asian, he doesn't look Australian. Okay, I'm born in Indonesia. I grew up in Australia. I came back to Indonesia. I'm supposed to go back to Australia, but I'm stuck in Indonesia right now because of the COVID. So there we go. That's your answer. Okay, looks like there isn't any further questions. Webinar is awesome. I like it. Thank you. Thanks for the feedback. Click on the like button if you like it. Subscribe as well. Click on notification bell and we can notify if we have new webinars, new recording coming up. That'll be great. Thank you, Mdor. Okay. All right. I think it's time. We'll wrap it up. Thank you for being with me for the past 3 days. I know it's a lot of things to cover, especially tonight. There's a lot of material. If you didn't get it or you missed out, you're seeing this in the future, you know, feel free to go back and check the first session and the second session as well. It's supposed to come into a 3-part series, so you better start with 1, 2, and 3. If you just jump in on this one, you forgot the first one, the second one, then go look at that video, number 1, number 2, and then number 3. It's designed to be a series of a workshop for beginner traders. Can we meet you in the country? I guess so, but it's kind of COVID and I'm avoiding people right now. Maybe after COVID. We have discussed the difference between Forex and indices and others, and that's on the first webinar. Please go on to the channel and check the first one, because I discuss what the global market is and I specifically break down what the commodities, index market, equity market, currency market are. Thank you so much. That's a good feedback, Michelle. Thank you so much. I just answered that. Just watch the first one, okay? Because we talk about that in the first one. If you just jump in on this one, you need to watch the first one, the second one, third one. Okay, thank you, Albert. I really appreciate it. I cannot analyze your trade. I don't even know what positions you have right now, so I'm not in a position to figure out what you're doing. Okay, there's a link there on the analytics channel on Telegram, I believe. I think that's AutoChart's signals, right? Yeah, that's the link there. I believe that OctaFX team is posting right now. The analytics. I think you provide signals through AutoChartist, if I'm not wrong. Yeah, I don't know if you can get the 100% bonus again. but the code is there. It's beginner INT1, so feel free to use that. If it works for you, then I think you can get it again. But Team Okta FX probably can help you. Maybe speak with the customer service over there and they can help you with that. Okay. Any further questions, guys? Nope. All right, we'll wrap it up for tonight. Again, I thank you for the 3 days that we've done this workshop. Thanks, Hawal. That's really good to hear. That's what I want to hear. We're not doing a live trading session here, so don't post quotes on currencies. I'm not going to look into it, okay? Okay. Team Okta, please answer Mr. Vinod there. How's that going to work, okay? All right, guys. Signing off from me. Stay safe. I look forward in the future webinars in English, obviously, and hopefully that's going to happen very, very soon. Stay safe. Always use the stop loss. Manage your position well. Remember, this is not a get quick rich scheme. You got to really focus on this. That's why we provide all these educational webinars. Hopefully this is going to be useful for you, and I look forward to doing more English sessions with you guys. All right. Thank you all. Have a great evening, morning, afternoon. Have a good day, and I'll catch you on the future webinars. Stay safe, okay?